Okay, this is the Chapter 16 exam review of the most missed questions. Before we get into this chapter questions that were most missed, I wanted to kind of briefly go through the time value of money, what I'll call a little quick take of it. Okay, there's three types of cash flows. There's a lump sum, there's equal payments, and then there are irregular payments that happen different amounts at for different periods, and we'll discuss this later. Now, there are four simple table formulas that are in the back of your book, or sometimes you can see these on either a calculator or they're on an internet. And for the purposes of these questions, we're always going to be in this situation where we know three parts of the formula and we're trying to find the fourth part. So for a lump sum type of cash flow, there are two basic formulas. There's a present value of an amount and there's a future value amount. And the way this little formula reads is the present value of an amount is equal to the future value, which is also some lump sum amount, times a table value, which you know the number of periods involved and the interest rate involved. So there's four pieces. The present value of the amount, the future value of the amount, and then the number of periods and the interest rate. Also, if you're dealing with a lump sum, there's the other possibility, which is the future value of an amount. And again, this full formula reads as follows. The future value of an amount is equal to the present value times the table value, which represents a certain number of periods at a certain interest rate. These two formulas are reciprocal of each other. You can basically find either one and you'll come up with the right answer. Now, if you're dealing with a series of equal payments, that is, you're going to be looking at sometime in the future getting a series of equal payments, that's what's called an annuity. And there's two formulas involved in that. So the way this reads is the present value of an annuity equals the periodic payment times a table value, again based on a certain number of periods and a certain interest rate. And you're either going to be dealing with the present value of an annuity or the future value of an annuity. And that would read the future value of an annuity is equal to the periodic payment times some table value that represents a certain number of periods at a certain interest rate. So, how to solve these kind of problems? Well, you're going to first of all ask just two questions. First of all, the type of cash flow. Are we dealing with a lump sum or a series of equal payments? Once you've done this and know what type of problem you're looking at, whether it's lump sum or equal payments, you've already eliminated two of the four formulas, right? And then the next question you're going to ask is, once we get down to these two formulas, which of the four formula parts are unknown? I should say, which of the, and so once you know that, whether in your, let's say in this situation, you know you're dealing with a series of equal payments. Well, if you know, for example, the periodic payment, which would be for both of these, and you know the table value information, which would be the periods and the interest rate for both of these situations, then the question would be, this money that you're getting, this amount that you're getting, is it in the present or is it in the future? And once you know that, then you can also know which of these two tables to use. Here's our first question. XYZ projects that they can get $160,000 cash per year for 5 years on a real estate investment project. If XYZ wants to earn a rate of 12% per year, what is the maximum that they should pay for this investment? And they already tell you to use Table 2, but I'm going to go through my little summary of how you would find about this. First of all, you have to ask the question, what type of cash flow is mostly involved here? Are we dealing with a lump sum situation, or are we dealing with a series of equal payments? And it looks like you can see here on this little timeline that we're dealing with 5 equal payments. So these 5 equal payments means that we are looking at some type of annuity situation, not a lump sum. The next thing you want to do is ask the question, is this unknown that we're trying to find in a formula, is it going to be in the present or in the future? So let me review this one more time. They're trying to look at an investment. They want to buy this piece of real estate, And this is how much should they pay for this real estate if they think it would be giving them a 12% return for 5 years. So you've got the table value information, you've got the 5 periods, you got the 12%, you've got the equal payments. So now the question would be, are we dealing with a present value of an annuity, or are we dealing with the future value of an annuity? And the way you answer that is, when are you going to make this payment for this investment? Well, you're going to pay for this investment back here at the very beginning at time 0. So when you've made the payment, that will be considered the present. And so we're dealing with the unknown that's in the present, so we're dealing with the present value of an annuity. Now, so you just take this present value of an annuity formula, which is the present value of an annuity is equal to the periodic payment times the table value, and in this case it's based on 5 periods at 12%. And so you've got 3 of the 4 parts that you know. You can find this 4th part, which is the present value of the annuity, by plugging in all this information. So you take $160,000, go to table 2 in the back of the book, and look at 5 periods at 12%. That's a table value that is 3.604776, and rounded to the nearest dollar, that looks like that $160,000, each of those, all 5 of those payments are worth $576,764. Now, here's what's really to keep in mind also. So you're getting $160,000 a year for 5 years, and that is a total of $800,000. But the fact that you have to wait to get this, that means that this money right now is only worth, discounting all these 5 payments back to the present, is only worth $576,764. Again, to summarize, in this problem we had a series of equal payments, and so we're dealing with an equal payment situation. Next is the unknown. That is, the unknown in this formula, is it something that is in the present or in the future? And it's in the present because that's when we're going to actually pay for this investment, and so that's the present value of annuity. And then we're going to take that present value of annuity formula, plug in the pieces that we know, find for the unknown piece. Our next question: assuming equal time intervals between the payments and a constant rate of return, which of the following cash flow patterns represents an annuity? Remember, we said an annuity is a series of equal payments. So here's A. We've got equal payments each year of $1,360 for 6 years. Here's B. We've got equal payments, but we don't get a payment in year 2 or in year 6. And then finally there's year C, where we have payments that are unequal. Well, the answer here is A. A series of equal payments, and that meets the following criteria. Equal payment amounts, yes, that's A. Equal time intervals, which they told you to assume that for all these 3 situations. And then finally a constant rate of return, which they also told you to assume. So the answer here is A. XYZ Company has 2 investment opportunities. Both investments cost $5,000 and will provide the following net cash flows. So investment A will give you $3,500 each year for 4 years. Investment B gives you uneven returns of $3,500, $4,600, $2,500, and $1,200. And the question wants to know, what is the net present value of the investment A's cash flows, assuming an 8% minimum rate of return? And they want you to use table 2, and table 2, by now you should know that table 2 is the present value of an annuity table. And so we're looking at equal payments of 4 years, $3,500 each year, and we're looking at 8%, and again for 4 periods. So the net present value is a calculation that's, in this case, we want to take to find that, we'll take the present value of these cash flows right here, and then we'll subtract off the cost of the investment, which was $5,000. So I'm going to do that in this formula down here below. So first of all, I'll take the present value of an annuity is equal to the periodic payments times the table value based on 4 periods at 8%, and then I'll subtract off this $5,000 and see if I have a positive or a negative net present value. So here we go. In this one, we've got $3,500 times a table value from table 2 that's 3.312127. And when you multiply the 3,500 times that table value, you end up getting $11,659. I didn't show it here, but that's what you end up getting. So it's $11,659 minus what your investment was, and you end up with $6,592 net present value. Another way to look at this would be to say, I'm going to invest $5,000 and I'm going to get $3,500 each year back from this investment for 4 years. And so after I get an 8% return, I have a net present value from this investment of $6,592. So in summary, the net present value is equal to the cash inflows, which would be these $3,500 payments discounted back to the present, minus the cash outflows. And these cash inflows and cash outflows are all at the same point in time. Remember, you made the investment at time 0, which was like in today's dollars, this $5,000, and you're getting these cash flows out in the future. But when you do this present value calculation of an annuity, what you're doing is you're taking all of these cash flows and you're putting them back to time 0. So you're comparing cash inflows at time 0 to cash outflows at time 0 to come up with a true net present value. Our next question starts off with, an investment that costs $38,500 will produce annual cash flows of $12,890 each year or each period for 4 years. Given a desired rate of return of 7%, and that's simple interest, what will the investment generate? They want you to use table 2 and don't round intermediate calculations and round your answer to the nearest whole dollar. All right, this is a problem that deals with net present value, and net present value is equal to the cash inflows minus the cash outflows. And again, let me remind you that these cash inflows and cash outflows have to all be, to make them comparable, have to be all at the same point in time, which this time is usually or always going to be time 0, which is right now in the present. So here's our formula. To find this out, we're going to take the present value of an annuity, because these are equal payments, right? And the present value of annuity is equal to the periodic payment times the table value based on 4 periods at 7%. And when we get this present value of these cash flows, we're going to compare that with the cost of the investment. So again, we're taking the $38,500 that we're going to spend, which is cash out, which is the cost of the investment right here. And then we're going to take these cash flows that we're going to receive over 4 years of time, and we're going to discount all those back to the present. So we're comparing cash inflows to cash outflows at time 0. So the periodic payment is $12,890. The table value in table 2, based on 4 periods at 7%, would be 3.387,211. And then that's going to be, you're going to subtract from that $38,500, which is the cost of your investment. The cash flow payments discounted back to the present are going to have a net present value of $43,661.15. And you'll subtract off, now they're at time 0. Now you're going to take the time 0 cash outflow that you paid for this investment, which is $38,500. And you end up with a net present value of $51.61. And by the way, net present value, if it's a positive, which is what this is, means it's a go. If it had been a negative, you'd say no go, we don't want to do this. All right, before we get going with this problem, I'd like to say that probably this problem could have been worded a little more clearly, and I'm going to hopefully clear up those places that could have been worded a little better. So here's the question. XYZ is considering starting a small business. XYZ plans to purchase equipment that costs $143,000. Rent on the building used by the business will be $23,000 per year, while other operating costs will total $28,800 per year. Marketing research specialist estimates that XYZ's annual sales from the business will amount to $87,000. XYZ plans to operate the business for 6 years. Disregarding tax effects, or the effects of taxes, what will be the amount of annual net cash flow generated by the business? Well, when I read this question, my first thought is it should have been worded as follows. What will be the annual amount of cash flow generated by the business from operations? And so what that tells me is that I'm looking at things strictly on the income statement. And the problem also doesn't talk anything about when they purchase this equipment, how they're going to handle that, because it's a purchase of you're going to buy it, you're going to finance it, or you're going to pay cash for it. But once again, they didn't mention anything about that. So based on that being a gray area, but like I said, I think the problem should have said cash flow from operations. Well, here's what the answer will be based on maybe clearing this up a little bit better. The annual net cash inflow will be sales, and which are really what we're talking about, revenues minus expenses, and these are cash revenues minus cash expenses. So sales minus rent minus other operating costs, and that would be sales based on the information above, which would be $87,000, and rent, which would be $23,000, and other operating costs, which would be $28,800. What it ignores here is the cost of this equipment. Well, when you buy equipment, it's used as put on the books as an asset, and then the depreciation on the equipment comes down into the income statement as an expense, but it's a non-cash expense. So the answer here would be just to use these items that were assumed to be cash revenues and cash expenses, which comes out to be a net annual cash inflow of $35,200. Our next question starts with XYZ company has 2 investment opportunities. Cash flow schedule for the investments is provided below. We have investment A, investment B. Investment A, you invest $5,000 in today's dollars, that's times 0, and then you get back $2,000 each year for the next 4 years. Investment B, you invest $6,000 and you get back uneven returns of $3,000, $2,000, $2,000, and $1,000. Now, considering the unequal investments, what is the best technique to choose the most appropriate investment, A or B? Well, your book likes, and I guess it's probably true, that the best technique to use is what's called the present value index. And the present value index would be the present value of the cash inflows divided by the present value of the cash outflows. And that would give you a number, some kind of index number. And higher index numbers indicate higher rates of return. So you would do that on this situation. You would take investment A and you would say the present value of the cash inflows, which would be these 4 $2,000 payments, and divide that by 5,000, which is the cash outflow. Do the same thing for investment B, which would be the present value of cash inflows, which would be these uneven amounts. And in that case, you couldn't use the present value of an annuity. You have to use the present value of a single amount, and you have to do this. You'd have to make this 4 calculations, add them all up, and then subtract out $6,000, or excuse me, you'd have to divide it by $6,000. And whichever one of these gave you the highest present value index, that would be the investment you would choose, at least on paper it would be. Now, can we compute the present value of these investments, or even the present value of the index? The answer is no, because we don't have a rate of return. So the shorter answer here is that the best technique to choose would be the present value index. Our next question, XYZ company is considering 2 investment opportunities whose cash flows are provided below. We have investment A, where they're going to invest $19,000 and you're going to get back 4 years worth of cash flows, and they're all even except for the last year, which is a different amount. Investment B, they're going to invest $13,800 and get back 4 years worth of cash flows that are all uneven amounts. Now, they want to know the company's, or they tell you that the company's hurdle rate is 12%. So someone in the back raised their hand and said, well, what is a hurdle rate? Well, a hurdle rate is the minimum rate that a company expects to earn when investing in a project. So now we've got a rate of return that we expect. We've got number of periods, which is 4. We've got the initial investment for each of these projects. And they want to know what is the present value index of investment B. They don't want you to tell which one of these has the higher present value index. They just want you to calculate the the present value index of investment B. They want you to use Appendix Table 1, which is the present value of an amount, which is a lump sum amount. Do not round in intermediate calculations and round your answers to 2 decimal places. Okay, so net present value of cash inflows equals the expected cash flows times the present value factor for each period. So we're going to do the following. We're going to figure out the present value of all 4 years of these cash flows as follows. The 6440 will be this table value, which represents 1 period at 12%. The next year will be 5280, which will be the present value table that represents 12% for 2 periods. That is under the amount, present value of the amount table. Next one, it'll be 4760 times this table value, which represents 12% for 3 periods. And then finally, 2920 we multiply times the table value that represents 12% for 4 periods. When you multiply all these pieces out, I didn't do them individually here like this, but when you multiply them all out and then get a total, you get that the present value of all these cash flows is $15,203. That's the present value of all these cash. Did I say outflows? I meant to say cash inflows. And of course, the present value of the cash outflow, which is with the amount of investment, is $13,800. So before we go any further, I'm hoping you can see that if you're going to spend $13,800 and you're going to get back $15,203, that's a good deal, and you should go and do that. But that's not where they want you to stop. They want you to come up with the present value index. So the present value index will be the present value of the cash inflows, which would be the $15,203, divided by the present value of the cash outflows. And remember now, both of these cash flows are now in times 0. They've both been discounted back to the present, which is times 0. So that'll be $15,203 divided by $13,800, which is the cash outflow, and our present value index is 1.10. If we had done the second one, or this one over here, we'd have figured out which one had the higher present value index, and at least on paper we would have gotten which is the better investment alternative, A or B, using the present value index, but that's not what they want you to do. An investment that costs $6,500 will produce annual cash flows of $2,900 for a period of 4 years. Given a desired rate of return of 10%, what is the present value index? Okay, they want you to use Table 2, which is the present value of an annuity, because we have equal cash flows here of $2,900 for 4 periods. So our little formula is going to be that the net present value of these cash flows will be the expected cash flows times the present value factor for each period, and that'll be present value of an annuity. The periodic payment here will be $2,900. That's the equal payment. The table value of this present value table will be based on 4 periods. That's 4 years, 10% rate of return. And so $2,900 times the table value in the book for 4 periods at 10% will be 3.169865. And that means that these cash inflows are going to be equal to, in today's dollars, equal to $9,193. So we're going to spend $6,500 and get back $9,193, and yay, we should do this every single day. That's not what they want us to do, though. They want us to come to the present value index calculation, which would be the following. We'll take the present value of the cash inflows, which were $9,193, and divide that by the cash outflow present value, which was the amount we paid for this investment, which is $6,500. That's going to give us a present value index of 1.414, and higher is better, and we don't have anything else to compare it to, so that's just the answer. XYZ Company is considering a capital project that delivers a $52,500 annual net cash flow before tax. This is before tax. The investment will result in an annual depreciation expense of $11,000 each year over the project's 4-year useful life. It didn't say each year, but I'm telling you it's each year. Assuming a tax rate of 40%, the question wants to know what amount of annual after-tax net cash flow will be provided by this project. They want to know the after-tax net cash flow. They give you the annual before tax cash flow. So to get this annual after-tax cash flow, you're going to need to take the annual net cash flow before taxes, which is $52,500, and subtract off the tax expense. Now, here's something to keep in mind in this problem. They've given you the annual net cash flow before taxes, which is a positive $52,500. And the way they got this number is to take all cash revenues and subtract all cash expenses. And when they took all the cash revenues minus all the cash expenses, they've got a net cash flow before taxes of $52,500. Notice I said cash expenses. Well, depreciation is a non-cash expense. It's deductible for tax purposes, but it's a non-cash expense. So it will lower your income taxes. So keep all this in mind, and we'll go to the next step of this calculation. Now, if you want to get the annual net cash flow before taxes, you would take, well, let's go down this line. So the annual after-tax net cash flow will be this $52,000 we were talking about, $52,500, minus the income taxes. And the income taxes will be figured on this $52,500 minus $11,000, because this $11,000 worth of depreciation lowers your income taxes. And so the $52,500 minus $11,000 times 40% means you're only going to be paying taxes on $41,500, not $52,500, but $41,500. So that means that your annual after-tax cash flow will be this $52,500 minus the taxes of $16,600, because that's the amount of tax that you're going to pay on the $41,500, which is the annual before tax cash flow minus this depreciation, which is going to lower your taxes. So the answer comes out to be $52,500, which is going to be the annual net cash before taxes minus the amount of taxes you're going to pay, which are $16,600, to give you $35,900. This is our last question on the review. XYZ Company is considering the purchase of a piece of equipment that cost $113,400. The equipment would be depreciated on a straight line basis to its expected salvage value of $6,400 over its 10-year useful life. Assuming a tax rate of 40%, what is the annual amount of the depreciation tax shield provided by this investment? Another way to say this is, how much will your taxes be lowered from depreciation of this piece of equipment? Another way to say this is the amount by which depreciation shields the taxpayer from income taxes. All right, so the depreciation tax shield will be calculated as follows. You find the depreciation expense on this machine, or equipment rather, and multiply it times the tax rate. In this case, you'll take the cost minus the salvage value, that's called the depreciable amount, divide it by the useful life, and you'll get an annual amount of depreciation. Then you multiply that times the tax rate. For this problem, it'll be $113,400, that's the cost of the machine, minus the salvage value of $6,400. That amount in brackets will be divided by 10, and that annual depreciation will be multiplied times 40%. So we have $107,000 depreciable amount divided by 10 years times, again, the tax rate, which is 40%. This means that we've got $10,700 worth of depreciation each year times the 40% depreciation rate, and that means that the tax shield this taxpayer will get from this depreciation for this equipment will be $4,280 a year.